An introduction to real estate depreciation. Depreciation is the annual deduction in the value of a property until it becomes obsolete. In many countries, real estate depreciation can be used to claim tax deductions over the income generated from the asset and also recover the cost of improvements or maintenance of the property. The deduction ends if the asset becomes obsolete or recovers the cost after gradual deduction of years. It also stops when the property is sold out. An important rule is that the value of the land is not included while determining the total basis for depreciation, since it accounts only for assets that wear out over time. The mechanism involves a building which is depreciated annually and the appropriate rate is applied to the acquisition cost of the property, which gives the value of depreciation. Depreciation is calculated by determining the cost basis and the total amount paid to acquire the property. This includes any installation costs, attorney fees, etc. If the cost of land is also included, it needs to be deducted from the cost of the building. Also, make any additions or deductions from this value to account for any costs or earnings on the property until it's ready for rent. Then, calculate the depreciation amount using the appropriate rate and the method suggested. Depreciation for improvements are fencing, carports, lighting, appliances, window coverings, floor coverings, and the wiring of the building. Cost segregation study should be done and apply the appropriate depreciation rate and method to deduct improvements. According to the Internal Revenue Service, the depreciation rate of a building is 3.6% each year. The recovery period varies as per the method of computing depreciation. It is 27.5 years for residential rental property under the general depreciation system and 30 or 40 years under the alternative depreciation system. Let us go through an example to determine how much a building is depreciated each year and assume that Artemis had bought an apartment in August 2022 and she rented it out at €150,000. First step. Determine the cost basis. The basis of a real estate asset is defined as the total amount paid to acquire the property. For example, Artemis property is for €160,000. This is around €168,000 when all financing, due diligence, legal, and closing fees are added. Having the total cost basis, you must deduct the land cost. In our example, Artemis property was last assessed at €130,000, and the appraiser valued the apartment at €100,000. Therefore, the land was valued at €30,000. This €30,000 can then be deducted from the total €168,000 to get Artemis's current cost of the building, which is €128,500. Finally, Artemis would need to account for any improvements or earnings generated on the property. Improvements include the cost of restoring damages and rehabilitating. Artemis invested €10,000 to make the property ready for rent, and her adjusted basis is around €138,500. Second step. Determine the method. Most properties are depreciated by using the general depreciation system methodology. Third step. Determine the recovery period. Artemis's recovery period will be 27.5 years under the general depreciation system method. Fourth step. Determine the depreciation amount. The depreciation amount equates to 3.6% of the adjusted basis depreciated annually. Artemis's asset was ready for service in August and would depreciate by €5,035 each year. After accounting for income and expenses involved with the property, Artemis can deduct this amount to lower the taxable income. Assume the tenant pays Artemis €16,000 in rent annually. Artemis's property expense of insurance and other maintenance cost was €2,000. If we depreciate the asset for €5,035, it reduces Artemis's taxable profit to €8,965. If you have found this video useful, please like, Share and subscribe for more videos and write your comments or questions.